Hi, so today I'd like to go over stock investing. I'm going to go over this from a very simple layman's perspective. What I would like to accomplish here is to get people who have no idea about anything in stock investing to understand some basic practices and some basic ideas so that when you start investing, you're not gambling. A big problem that I see is that a lot of people think they know what they're talking about, they think they know exactly what they're investing in, and then when you ask them, so why did you choose to invest in this? They can't give you a good explanation. They can talk about how they think it's a sure thing. Oh, look, this is going up. Oh, they have great potential, this, that, and the other. But then I go, okay, so why should I put $50,000 into this? Explain. They cannot explain it. And this is a serious problem. So what I would like to do here is provide you with some information that you can use to judge whether or not a stock investment may be a good use, a good way to spend your money. So what I would like to do is just go over what some of these basic terms mean when you look over a financial statement or when you see all the stats in Google Finance or Yahoo Finance. I know that there are a lot of new people that see all these abbreviations. They have no idea what the hell it means. They have no idea what they're doing, and I would like to explain it in the simplest manner possible. We're going to go over how to tell if a company is in good financial shape or bad financial shape. I'm going to go over how you can tell if a stock is undervalued versus overvalued. We're going to go over what makes a stock go up or down, because a lot of people don't even know what sets a stock price, which is a little bit scary when they are telling me that they want to invest $20,000 or $30,000 of their money in a market without even knowing what makes a stock go up or down. And we're going to go over some examples of stocks that have gone up and down, what caused them to go up and down, and I'm going to go over a little bit of the difference between speculating and real investing. So speculating is, from all intents and purposes, to me, what speculating means is, put it all on red or rolling the dice at a casino. And I don't want you to trick yourself into thinking you're investing when you're actually just rolling dice at a casino. A lot of people, they like to think that they know what they're doing. They like to think that they're investing when they're actually rolling dice at a casino. So with that said, let's get into the introduction. We're just going to get this picture of BlackBerry off the screen. I'm sorry for any of you who have particularly enjoyed the picture of BlackBerry on the screen. You'll get to see more of her later. And let's get into the topic of the video. So the first thing to go over here is what is going to set the price of a stock. What's scary is that people think that Kramer on the TV or somebody at a local bank is going to set the price of a stock, that somebody writes down a number on a chalkboard and that's what the stock is going to trade at. And it's not like that. It's very much based in supply and demand. So let's just go over some basic principles of supply and demand before we get into the stock that I have on the screen here. So with supply and demand, if I'm selling something, for me, it would be ideal if the price were high, because I want to make as much money as I can when I sell something. As a buyer, for me, what would be ideal is that the price be low, because I want to spend the least amount of money possible when I buy goods or services so that I have the most money in my bank account. So for the buyer, his bank account is best off when things are cheap, and for the seller, his bank account is best off when things are expensive. So let's go over what's on screen over here. I want to draw your attention to three attributes right now. So ignore all this other stuff and blah, and let's just focus on three things right now. The price of the stock right now, which is $20.91 per share. The second thing I want you to focus on is the bid. The bid is going to be what's best for the seller. So the bid means that there's somebody out there right now that wants to buy 1,700 shares at $20.90. The bid that you see is always going to be what's best for the seller. Remember, the seller wants the highest price possible for his stuff. So the bid that you see is going to be the highest bid available in the marketplace at the time, which right now is $20.90, 1,700 shares. The ask is going to be what a seller is asking for when they're selling the stock. Conversely, you're going to see here the best selling price, meaning what's best for the buyer, which is the lowest price. So here you're going to see the lowest price that somebody is willing to sell the stock for, and we have 2,000 shares. Now, there's more people who want to sell this at $20.91 than people who want to buy at $20.90, which is going to drag the price closer, I would say, to lower. So let's just refresh and see what's going on here. As you can see, after I refreshed, it lowered to $20.89. Now, if we look back at the bid and the ask, you'll see that there's more people that want to buy than people that want to sell, which is going to cause that price to go right back up. So the bid, 3,800 quantity, $20.88. ask, 2300 quantity, 2089, and this is going to go back and forth like a seesaw all day. And as you can see when I refreshed it, it went from 2088 to 2088.5. And this is going to continue on all day, and this is just based on supply and demand. What sets the stock price are all of you. What are you willing to sell it for, and what are you willing to buy it for? So what's setting the price of the stock is purely market-based. If several million people come in today and they want to buy this stock at 30 bucks, you guys are going to set the price of the stock to go closer to 30 bucks. And if every single person who owns this stock, if all the owners of the stock are willing to sell it at 5 bucks, you're going to drive the price down to 5 bucks. So the first thing I want to get into your head is that the investors themselves are setting the price of the stock. It's not some eye in the sky that writes in a chalkboard a number and sets the price of a stock. So supply and demand is going to set the price of the stock. Now we can move on to the next aspect. So now we're going to go over some things that may affect supply and demand. Since we know that supply and demand is what's going to make a stock go up or down, what's going to cause people to sell a stock versus buy a stock? People often buy a stock on good news. We want to own a company when it's a good company, and they sell on bad news because we don't want to own a company when it's a bad company. So what makes a company a good company or a bad company? What makes a company a good company is that it makes money. What makes a company a bad company is that it loses money. So let's go over one example that I've talked about on live stream many times so I can explain my rationale between why I bought into CXW several months ago. So CXW is a stock for CoreCivic Inc., used to be Corrections Corporation of America. They operate private prisons. And you can see over here over the past 6 months, look, they're 34, 32, 31, and then right around August 18th, it goes from 27.22 to splat, 17.57, and then and then just keeps blowing up. So what caused that huge jump over here? If you look at the news, Justice Department says it will end use of private prisons. And they're talking about how they find them less safe and less effective, and they're saying that they plan on phasing them out. And there's an article on it. And so you read this news and you see that, okay, they're thinking that they want to do that. You'll see that the stock continued to go down through September. So in September, it was sitting around 16.15. And then 14, 13. And if you look, you'll also see that Hillary Clinton talked about ending private prisons. And there's news about that. You're welcome to Google that Hillary Clinton made private prisons an issue, and during the election, Donald Trump did not make private prisons much of an issue. So this would have shot it down even more. So the Department of Justice is saying end private prisons, Hillary is saying end private prisons, and this is how political news can affect the price of a stock. Now, here's what I did at that time. I did a little bit of my own research, and I said, okay, what are most people in federal prison for? I did my research, and I saw that a good amount of the offenses are drug-related offenses, heroin, cocaine, etc. And there are no laws in place. There's no new legislation to make those drugs legal. Okay. Now I looked into what the state of our current federal prisons are, and they're overpopulated by about 20%. Okay. And while they're talking about how they plan to get rid of private prisons or phase them out, their plans, they don't really seem to be making the laws more lax so less people go to prison, and they don't really seem to have much of a great plan. It seems to be like something that they said because it would look good for politics. So to me, when I saw this news, it struck me as, a politician just made up a campaign lie so that they would look good in front of camera. And that's what politicians often do, whether it's Republican, Democrat, third party, politicians are often full of shit. And I saw they talked about how they would amend a solicitation for this contract to this and blah-de-blah-de-blah. But when you look at the actual numbers, it didn't make any sense. You're not going to end private prisons anytime soon unless you buy them. So I looked at this and it seemed like a lie. And this lie resulted in the stock going down in value by a lot. Now remember what I said about supply and demand. A stock is going to go up in price when the demand for the stock is greater than the supply, meaning more people want to buy it at a price that's higher than what people are willing to sell it for. And the stock is going to go down when there is less demand, meaning more people want to sell it at a price that people are not willing to buy it at. So when you see a stock tumble like that, what that means is that the people who own large amounts of shares, not like regular people like me, but the Charles and David Kochs of the world and the JP Morgans and the hedge funds got news before we got news. Again, they are rich. They are getting the news directly from the source. We're just waiting for it on Google and Yahoo. But that means that they all en masse decided, based on their news, this is a bad stock, dump it. What happens is that all of those institutions will start dumping the stock. And when you have this influx of people that want to sell, you're going to have more sellers than you do buyers. When you have all these huge funds that are just dumping shares out into the market. And what that does is that lowers the price of the stock. So what happened here is that probably you had a bunch of funds, a bunch of rich funds that decided, we just want to dump this stock, and probably a lot of regular investors as well. But when you see those types of large movements, often it is some hedge funds and banks and large mutual funds that are eradicating this stock from their fund, and they're all hoping that they are going to sell it before the price bottoms out. So what happens is usually they dump it, and then the regular people like us wind up being the bag holders because we're the ones that find out this news after they've already sold it. So most likely what happened here is all those funds decided that they wanted to dump the stock, and then we, the regular stock investors, are stuck as the bag holders. Now, the one good thing that happens out of this is that if you are not invested and you believe that the analysts are wrong, or you believe that they're acting in paranoia, all of those stock analysts for all these mutual funds and hedge funds and banks, what they've done is they've lowered the value of the stock by going into this mass sale, which then results in an excellent buying opportunity for a regular investor, assuming that the stock itself is still a good pick. So here we have to now analyze the company and analyze the news and debate to ourselves, did this go down in price by almost 50% because it is a piece of crap, or did it go down by 50% because all of these analysts that are selling are simply paranoid? Yeah, the worth of the company, the worth of the stock is only as high as the opinion of the collective shareholders of the stock. If everybody who holds the stock believes that this stock is worth insane amounts of money and nobody wants to sell it because they just believe it's so valuable, well, then it is, even if the company is shit. Conversely, even if the company has a decent track record, good income, and has good prospects, if everybody holding the stock thinks that the company, thinks that the sky is falling, then the value of the stock will fall. Now, me as an investor, remember, I'm the buyer. And one of the things that drives me particularly nuts when it comes to investors is how everybody always focuses on, I want to buy the stock when it goes up, when it's high in value. Because that's not how I go to the store. When I go to the store to buy a set of shoes, and let's say I have a set of shoes that I buy, I like to buy the same set over and over again because I'm boring, and it's usually about $80 or $90. If I go to the store and I see it's $150, I don't go, gee, let me buy 5 of those shoes instead of 1 pair because it went up in price. No, I say, fuck it, I'll come back next week when it's cheaper. If I see them on sale for $20 or $30, I may buy a lot. I like buying things when they're cheap, not when they're expensive. So I did my research and I saw that the value of this stock went down based on very little other than political conjecture. So people speculating based on the words of a politician. Am I going to trust that this stock is worth just about half the value in October as it was in July on the words of the Justice Department or Hillary Clinton, who want to look good during an election year? Fuck no. So I decided to buy. And I did my research. I saw that the only way to feasibly phase out private prisons, when you look at who's in the private prisons, what the crime law of our country is, and what the population of the private prisons versus the public prisons are, the only way to actually get rid of them would be to buy the prisons. And if you're going to do that, the company's going to do well anyway. So we see over here that when Trump became president, it went up from $14 to $20 and has been on a slow, steady rise from then up to 22 and to 23 and so on and so forth. So that, because Trump, unlike Hillary, made no claims on private prisons and, if anything, was railing against how he's going to change all these things in government and how, he was railing against a lot of the same individuals. I guess not the same individuals, but the same department that was talking about getting rid of the prisons because he was criticizing the Department of Justice for protecting Hillary Clinton in the first place in this election. So Trump winning was a win for the private prison stock. And then over here, somewhere around here, I wound up selling. It could have went up more, but I didn't really want to risk it, and I made my money. So this is how news can affect the price of a stock. And I want you to know the difference between a stock going down because the company has genuinely lost and failed versus it going down just based on speculation, politics, news, and other BS. Here, this stock went down because a politician opened their mouth. And they open their mouth during an election year. And when they do that, I want you to get into this analytical mindset. I want you to think to yourself, why did this stock go up or down? What type of news was this? Was this like was this news like news, or was this news like a talking head just flapping their gums to look good for the voting public? Now, before we jump in and invest in CXW, just because somebody, some politician on TV said something bad about it who's probably trying to pander to the public, before we do that, let's just make sure that the company is actually on some solid ground. So we're going to use SEC filings. So SEC filings are forms that these companies need to file with the SEC if they're a public company, and some of them are very useful. To me, the most useful forms are the 10K and the 10Q. The 10Q is a form they file every quarter, and the 10K is a form they file every year, and it gives you good information about the company. Scottrade has a decent enough website where they post that stuff so I can see either annual or quarterly, and I can click through it over here. Now, when you download the form, the cool thing is that in the 10K and the 10Q, they'll often tell you what makes them competitive, what they're worried about, what they're up against, what may increase the price, what may decrease the price. You can really learn a lot about a company from reading the 10Q and the 10K. There's a lot that you can learn that you're not going to learn just through looking through press releases and other horseshit on message boards or what you see on TV. So what I'm going to do over here for now is I'm just going to look up at the financials, and we're just going to see what they made. So on the income statement, we're just going to look at a quarterly income statement, then an annual income statement. And let's just check a couple of things out. So their net income, it's not going up. It's not really going down pretty much. So, it's pretty steady in the 40s to 50s. Now, if we go annual, let's just see if there's any crazy losses. It actually seems like, man, it's up here. It looks like it's kind of going up from where it was several years ago. So the net income is steady. Now we're going to look at the balance sheet. The balance sheet is going to tell me if the company has a ridiculous amount of debt, what they have in assets. So there's a couple of different sections to the balance sheet, and we're going to get more into the balance sheet later. So yeah, up here you have assets. So this is crap that the company has. Over here you have liabilities. This is what the company owes. So for example, let's say you're a repair shop, because this is a repair channel and a lot of people watching have a repair shop. So the cash that you have in your drawer in the bank, that is your cash. Over here, let's say buildings. Let's say you own the building that your repair shop operates in. That's your building, and here's the value of your building. Machinery and equipment. So let's say your soldering station, your microscope, all of that is an asset, and so on and so forth. Now, liabilities. Let's say you owe your vendor money. So let's say that you buy parts that you use to fix things and you haven't paid for them yet. That's going to be on your liability sheet. Now, at the bottom of this, you're going to see something called total equity. So total equity is when you take the assets, the stuff that you have, and you subtract the liabilities, the stuff that you owe, and from that, you will get equity. And as I can see here, the equity has stayed pretty consistent over time. The income has been steady over time, and the company's total debt is high, but it is lower than the assets. It's usually half the assets, sometimes 1/3 the assets for this year, which makes me feel good that I'm not investing into a dump. So after taking into consideration the news, after taking into consideration the reality of how you get rid of a private prison system, and after taking into consideration the financials of the company, I felt safe investing somewhere in the $13.74 point, and then I sold it sometime in the early 20s, about a month or two later. And this should give you a bit of an idea on whether or not something is a good buy. Now, you're going to see bad news for stocks that's legitimately bad. So let's go over to the Yahoo losers section, because here you're going to find a lot of interesting things. All right, so we're going to look at a Yahoo loser that's been on the losers list several times over the past few months, which is Feral Gas Partners. So Feral Gas Partners is some energy company, and as you can see, look, they were flying high at 20 bucks in August, and then 19, and then 16, and then 10, and then 9, and now 6, and you get the point here. So what I want to do here is I want you to be able to tell how I made my decision that I should not buy into this company, that the bad news about them was not just some little piece of temporary bad news, but very, very, very bad news. And as you can see, there's every single time a stock goes down by a lot, you're going to see a bunch of ambulance chasing lawyers over here. Like you're going to see like a bunch of name and name LLP, name and name LLC is suing them. Just scroll past most of that crap because that's not the actual news. That's a response to the news that something bad happened. Somebody's always trying to get money. Some lawyer's always trying to get money. So we're just going to scroll past that. The real issue here is that, to want a piece of news I'm trying to find, is that they acquired some facility, and that facility had a large customer, and that large customer no longer needs their services. So the facility they required is pretty much, the asset they required is pretty much worthless. So that was the Bridger acquisition. And you can read about that. You can Google that. This happened the news started getting reported about it about 2 months ago. And you can see that I'm at the end of my ability to scroll with Yahoo News. So we're going to see, is that really that big a problem? Is this company really in bad shape, or is that just one little misstep? And even though you can see it went up 10% today, if you look over the past month, yeah, that's even though it went up 10% today, you can see what the greater overall trend is with this if you just keep zooming out of the graph. Now, is it going to go back up or is it going to go down? There's one way to find out. Let's take a look at the company's financials. Let's take a look and see what we see. So if we look at their income statement annually, let's see what their net income is year after year. So net income, 11 million, loss. See, the red over here is a loss. Then they made 56, they made 33, they made 30. They lost 665 million this year. And if we go in a quarterly view of net income, they lost 59, they made 80. They lost 59, they lost 80, they made 57, they made 19, they lost 661. So if you look at this, it's kind of like they lost money, they made it, they lost, they made. It's kind of like they just kind of break even. And if you look at the balance sheet, that's where the real fail becomes obvious here. So let's look at my assets. So the assets go up a little bit. So from 5 years ago, you've got like less than 300 million more than you did 5 years ago. So a little bit of growth, but a big step down from last year. And then you look at the liabilities, and that's where this shit really gets scary. Look at the total debt. So not only does this company, as you can notice, have more liabilities than they do assets. So the assets is 1.68 billion and the liabilities is 2.33 billion, but most of their liability is debt. So, and also you'll notice every year the company debt increases by over 10%, except for this year. So from here to here, from here to here, this was much bigger than 10%. You know, this is like a little bit, this is maybe 10% increase, this is like 20 or 30% increase, 10% increase. So their debt keeps going up every year. And their debt is so high that even if they sold everything they owned, they're still about $500 million behind. Now, at their rate of making money, at their rate of net income, let's just take a look at the net income here. If you look at the net income, you'll see that they're lucky if they make $56 million or $33 million in a year. So let's say that they sold everything they owned, which you can't operate a company if you sell everything. Let's say they sold everything they owned, right? They sold all $1.6 billion of their stuff and they could still operate. It would still take them another, let's say, 20 to 30 years to pay off their debt, even if they sold everything they owned with their current revenue model. Not looking very good. Now, over here you see total equity, which, as I explained before, total equity is the total assets minus the total liabilities. And when you look at the total equity, you'll see that right now where they stand at an all-time low is minus $647 million. Adding insult to injury is the fact that this stock used to issue a large regular dividend every year. Now, if you look at the amount that this stock issues in dividends, it's considerably higher than the cash on hand, and it's also considerably higher than their actual net income. So how does the stock issue dividends, or I shouldn't say dividends, how does the stock issue out these payments to their shareholders on a regular basis if they don't make a lot of money? Sometimes they lose considerable money, and their debt is so high by increasing their debt. So this company every year is increasing their debt in order to pay out to the shareholders. And their income is shit. It's going crappier, and right now the company has minus $647 million in total equity, $2.1 billion in total debt, with an average net income of something like $30 million a year. This is this should be a penny. In my opinion, this is a penny stock. This is not, like, I don't look at this and think this is a one-time thing. Oh, the company has great finances. They just had one misstep. Yes, they did have one misstep where for one quarter they had to write off that asset as a loss. But, I mean, does this, like, again, let's just ignore this quarter where the income before tax was $670 million. Look at everything else. Look at this. Minus 61, minus 81, made 59, made 20, minus 670. Like, at this rate, how the fuck are you ever going to make up for this? You are probably not anytime soon, which is why this is trading at that shit price. And I could be wrong. There's a very good chance that I'm wrong. There's always a chance that I'm wrong, but I can only go on the information that's in front of me. I cannot predict the future. I cannot guess what they're going to do. I don't know what's going to go on in the future. I only know what's going on right now, and from what I see going on right now, I would rather not risk the money that I earned buying this. This, to me, seems like a Ponzi scheme. I mean, not exactly a Ponzi scheme, but again, when you look at the amount of money that they pay out, you look at the money that they pay out, when you look at the amount of money that they have on hand, and when you look at their actual net income, this adds up to me to being a penny stock. So again, it went up 10% today, and that may seem, and the sad thing here is that somebody may see this on the gains list, on the financial gainers, the winners for the day, and go, wow, went up 10%, and look, there's potential. It's like, if you look at this little graph over here, it's like, wow, we're making it, we're going somewhere. But if you look at the financials, it's like, yeah, no, I don't know. No, staying away from this. And again, what I'm trying to do here is teach you how to not gamble and how to not speculate. So if you buy something like this, you're welcome to buy a stock like this, but just realize that this is less investing and more towards the speculating and gambling side, because this doesn't have great prospects. Again, I could be wrong, but I prefer to avoid risk, and I like to make decisions based on facts and based on a strategy that I can explain to you. When I see that a company has, what is it here? Yeah, when they have $4.97 million in cash and $2.1 billion in debt, yeah, I don't want to invest in that. Now, even though that valuation, that minus $647 million thing just happened last quarter, this recent quarter, I want to show you how you could have easily been able to tell that this was going to happen based on the information that was in front of you. You see that there's the debt right every single year. You can see that the income is nothing special every single year. Their income is not enough that they can pay off this insane debt, nor can they pay out these crazy dividends while making such little money, while increasing their debt every year with their assets staying relatively static. Their assets are not increasing faster than their debt is increasing. So several years ago, their debt was $1.2 billion, and their assets is $1.3 billion. Now assets is $1.6 billion and debt is $2.3 billion. It does not take a mathematical genius to predict that eventually this just has to give. And if you look at their pricing over the last, let's say, 5 years, you know, it's gone between 20 up to 28, back down to 20. I mean, to me, this just doesn't seem sustainable based on their revenue model or based on anything else. Now, what I also want to go over with you are a couple of attributes that allow you to tell whether a company is is supposedly overpriced or overvalued or undervalued. And we're going to start going over what some of these statistics over here mean, like PE, like what does PE mean? What is price sales? What is price book? What are these ratios? What is return on assets? What does this mean? How does return on asset percentage relate to management effectiveness or any of this stuff? Because when you get to this page, this is where people kind of start to get confused and just their eyes glaze over and they go to TV and they say, Kramer, tell me what to buy. I don't want to read through all this. So let's get to that. Now we take a look at something called the price to sales ratio as well as the price to book ratio. These are a good metric to give you a general idea as to whether a stock is overvalued or undervalued, and it just requires a little bit of research and a little bit of math. Luckily, Yahoo will actually tell you what these numbers are up front, but I still want you to gain an understanding of what they mean, so I'm going to show you the formulas that you would use to find these numbers for yourself. So, price to book means what is the price of the stock in relation to the actual worth of the company. So let's go over a company like Rail. This is a company that I told you that I suggested as a buy about a few weeks ago in the iPhone 6 video and also on a couple of the live streams. And people asked, why do you want to buy this stock? What do you think makes it a good buy? And it's not really something I can discuss while I'm fixing a board, but when I have all the finances up here, I can give you an idea. So let's go over its price to book. So price to book is going to be the worth of the company versus its share price. So what we're going to do over here is we're going to find the total equity of the company. Now remember what total equity is from before. Total equity is the assets, meaning the cash, their tools, their buildings, their equipment, etc., so on and so forth, the stuff they have, minus the stuff that they owe, which are liabilities. So when you take $356 million in total assets for the most recent reported quarter, and you subtract $99 million in total liabilities, you come up with the total equity of $257 million. So if you were to pay off everybody that this company owes money to and then sell everything they own at market value, you would come up to the company being worth $257 million. That is what equity means. That is the company's total equity. Now, $257 million. So we're going to take that $257 million, and then we're going to check out how many shares of the company exist. So 12.39 million shares of the company exist. So we're going to do a little formula. What we're going to do is we're going to divide the number that I just forgot from 5 seconds ago by 12.39 million shares. Yes, my memory is that bad. So let's go back here, click quarterly. So 12.39 million are the amount of shares of the company that exist. And we're going to go 257 divided by 12.39. And we get the book value of the company is $20.74 per share. So what that means is that if we were solely judging the share price of the company, what the shares should be worth based on what the company is worth, that the share price of the company would be worth $20.74. And yet the price of the company is $14.94 a share. And you can also see that we got that number from taking the total equity and dividing it by the amount of shares that exist in the marketplace, which is 12.39. And if you go to Rail's page over here, you'll see that price to book over here is what we got. I got 20.74. They rounded it up to 20.75. Yahoo's trying to sell you on buying it. That's what that is. And the ratio over here, the price to book ratio, is the ratio between the actual share price and the book value of the company. So anytime you see that that number is below 1, the stock would be considered to be a good value because it's trading at something below its book value. So the per share price of the company right now is actually below what the company in and of itself is actually worth. Now, we can check out what the price to sales ratio would be in a similar manner. Sales means what is the company worth from a sales perspective. So what is the share price of the company in relation to what they're actually selling? So that's usually calculated not by the quarter, but by the year. So when we were calculating the equity, what I did, the book value of the company, what I did is I went to balance sheet, I went quarterly, which would show up in the 10Q, not the 10K, for quarterly, and I checked its equity, and then I divided the equity by the total amount of shares to come up with the book price. So now if you want to get the What was I just talking about? Now, if you want to get the sales ratio, what you would do is you would take the sales for the past year, so the past 4 quarters. So we go to income statement, we go quarterly, and what we do is we take total revenue, which is 113 plus 126 plus 149 plus 203, and that gives us $591 million, right? So we're going to take that $591 million. I pasted it this time because I know that I'm going to forget. I have a shit memory. And we're going to do market cap, which is the market cap of the company. So market cap, and we're going to divide that by the earnings, and you get the ratio, which is 0.31. So the market cap of the company is actually considerably below its yearly earnings, which means, again, that the stock would be considered by some people to be undervalued with its share price, which would mean that the stock itself is worth more than what it's trading for. And you can see that the number that I got, 0.313, matches up with the number that you get on Yahoo for price to sales. So both of these numbers are below 1. Price to sales is considerably below 1. Price to book is slightly below 1, which means that this probably has a good chance of going up. Now let's look at other aspects of the company's financials so that I can show you why I think that this is a good buy. Now, if we look over the balance sheet, take a look at the debt. I want you to take a really close look at the debt in the liability section. Look at the debt. That's a really nice number. That's an amount of debt that I think a lot of us wish that we had at times. Look at that, 0, 0. This company has very little debt, no debt, and the liabilities are very low compared to the assets. The equity is usually positive, and it is going up from year to year. This stock did have a slump because of earnings that weren't that great. Over the past, I believe, let's see, what do we have here? Income statement, yeah, over each year. Actually, no, it's net income. Here we go. Let's go to net income. 4.9 million, 19 million. They had a loss, 19 million. They had a gain, 5.9 million. And now we're up to 32 million. Let's look at it quarterly just to get a little bit of a better idea of what's going on recently. Okay, so they had a shit quarter. So recently they actually had 2 shit quarters. So they had a shit quarter from earlier in the year, and then in the middle of the year. So let's take a look at what the stock price did during that time over the past year. As you can see, the stock represents that they had 2 shit quarters. So we were at $21 at the end of last year, and as the 2 shit quarters came on, the shit sandwich, we went to 17 bucks, and then we went all the way back down to 13, and then around election time, it went down to $11, and now it bounced back up. Now, I thought that it was a decent buy because, first of all, at least according to the research I did a month or 2 ago, they used to manufacture freight cars that were used for carrying coal, and Trump is all, coal, we're bringing back clean coal and blah-de-blah-de-blah. There's that, but there's also the fact that the actual value of the company, both in revenue and equity, is considerably higher than what it's trading at. And from what I see, this does appear to be a temporary setback. If you look at the history of the company, again, they have a history of making money. The money that they're making is more than enough to cover their liabilities. The assets that they have are more than enough to cover their liabilities. Let's take a look here. So the total assets that they have at any given time is between 350 to 428 million. The highest liability they've ever had is 207 million. So they usually have twice the assets that they do liabilities. Recently, they have about 3.5 times the assets that they do liabilities. Their equity is good, standing good over time, and just seems like a fairly stable company. And if they do go into debt for some reason, they have room to go into debt because they haven't had debt over a long period of time. So I thought that this was a good buy based on everything that I saw. I bought it, and if you bought it around this dip over here when it was considered a loser, well, you were rewarded when it went back up to here. And I believe that I didn't sell this immediately. I firmly believe that this will wind up being one of the winners. That'll go to 17, 18, 19, and 20. There's only one way to see, but I'm basing my decision on the financials, on the value of the company, on the value of its sales and equity versus the share price, and I'm trying to show you what these things are in on paper, so it's not just me saying they look good or they're going to expand or they're a great company. What makes it a good company? You should always ask these questions anytime somebody says that a stock is a great deal. Because again, if they can't explain to you why they like it, they probably have no idea what they're doing. All right, so another attribute here to look at under management effectiveness is called return on equity. So how does return on equity tell you management effectiveness? Equity, just as a little primer in case you forgot from earlier, is going to be the difference between the assets and the liability of a company. So when you take the company's assets, their cash, their buildings, their tools, and you subtract their debt, everything they owe to other people, you get equity, which is the worth of the company. Return on equity is going to be the relationship between the company's earnings and the company's equity. So let's say that my company is worth $300 million, and let's say that I make $30 million. That means that my return on equity is 10%. That means that using my company's $300 million worth of resources, I was able to turn that $300 million worth of resources into $30 million in income. That is return on equity. All right, so let's say that my company has, just to give you a repair shop example, let's say that I have $30,000 in equipment, $30,000 in cash, $30,000 in inventory, and then I have $30,000 in random liabilities. So that would be equity of $60,000. So $30,000 plus $30,000 plus $30,000 for the assets minus $30,000 in liabilities. That would be $60,000 in equity. My company would be worth $60,000. Now, let's say that I'm slacking. I'm doing a long YouTube live stream. I'm reading the chat too much, and I'm not fixing anything. I'm not paying attention to the staff. I hired bad people. The bad people that I hired are being mean to the customers so that they don't want to leave stuff, and everybody's working really slow. We only make $600 in revenue that day. Since the company's equity, it's worth $60,000, and we made $600, that would be a 1% return on equity in that scenario. Now, let's say the next day I get my act together. I fire the people that are being mean to customers. I have a meeting with the existing employees that I kept. I hire new people that are good at their job. They're nice to everybody who walks in. They make people feel comfortable about leaving their devices. We get everything done really quickly. I'm busting my ass. I turn off the camera for YouTube and I actually start doing my work. And that day, instead of making $600, the next day we make $6,000 off of that using the same business that has a $60,000 equity. Now, my return on equity in that case would be 10%. So the whole idea is if you're doing your job right, if the company is being run properly, you're going to make more money given the same corporate structure and given the same equity in the business. So return on equity is there to tell whether or not management and the employees are doing a good job. If management and the employees do a better job, they're more efficient, you will see a higher return on equity. You will see that the company makes more money based on having the same tools, buildings, etc. that they had before. And that is the idea behind return on equity. Now, do keep in mind that different industries are going to have different rates for things like return on equity. And actually, just while we're discussing this, just realize that everything like the price to sales ratio, price to book ratios, these are all going to be different based on different companies. So we cannot compare and contrast a company that deals with coal and natural gas to a company that creates software, to a company in the aerospace and defense industry, to a biotech stock that creates medication. You have to compare within the same general type of business. That's a very important piece that I see people missing out on when they're discussing things like return on equity and price to book ratio, price to sales ratio, and everything else. You should only compare a company that refines oil with another company that refines oil. You should only compare a software company to another software company. You only compare a biotech stock to another biotech stock. So make sure to keep it within the same industry when you're doing these comparing and contrasting. All right, so in spite of what I've said, in spite of all those indicators, sometimes a stock is just going to go up or down for no reason, and there's really no getting around that. So let's just take a look at one stock that I'm invested in, which has a special circumstance surrounding it, BWX Technologies. So BWX Technologies over the past 5 years went up a little, down a little, up, down, up. The general trend has been up. The general trend with this stock is it goes higher and higher and higher. So let's just take a look at some of its statistics. Price to book is considerably, the price to book is lower than the stock price. The price to sales ratio is, I mean, if you look at the ratios here, this is actually not even the book price of the company. This is the price to book ratio. The actual book value of the company is $1.19. So this is a really, really high price to book ratio. The company's equity is, I mean, if you were basing the stock price on equity, it would be considerably lower. And now let's take a look. Maybe earnings have shot up or something. Maybe that'll be why it's gone up and up and up. So if we let's just take a look at quarterly earnings here, and you'll see that revenue is, it's slowly stumbling upwards, very slowly. If you look at net income, you'll see that net income is actually going down with time, even though revenue is going up. If we go annually, you'll see that the company used to make quite a bit more money than it makes right now. Yeah, so it's been going down over the past several years. If you look at its balance sheet, you'll see that, let's take a look at total equity. So the total equity of the company has actually gone down considerably. The debt of the company has continuously gone up. Several years ago, the debt was at $5 million. Now it's at $293 million. So let's just focus here. So the book value of the company is way lower. Book value per share is way lower than the share price. The earnings are going down and the debt is going up. In spite of that, the stock price continues to go higher and higher and higher. Well, why is that? Well, this company is in the unique position of having something of a monopoly towards providing fuel to U.S. Navy reactors. Now, the special attribute of this company is that there's not a lot of competition. Trying to compete with this company, again, good luck trying to compete with them for the U.S. Navy as a client. That's going to be almost impossible. So this company continues to go up and up and up and up. Even though the earnings are not that amazing, the book value is not that amazing, the equity is not that amazing, it just keeps going up simply because they have a monopoly on something, and that is that has caused it to continuously go higher. So you really do need to get the full story of a company. While these stats will give you a general idea of what's going on, they give you a general idea of what it's doing. As you can see, the return on equity is actually very high because it's in a different business than these other companies. So if we take a look at the balance sheet, quarterly balance sheet, total equity is $118 million. And let's take a look at net sales for that quarter. Net income is $41 million, so it actually does have a very high return on equity, so that's helpful. But also the fact that they have a monopoly on providing services for the government is quite helpful. So it does help to get a full story of how the company makes its money. And when you see things like this, I don't want you to think, oh my God, it's overvalued. I need to short that stock because it's overvalued. I don't want you to come to this direct conclusion. I just want these indicators to give you an idea that further investigation may be required before you come to a conclusion. Here, I thought further investigation was required because, like you, I looked at some of these figures and it's like, what? And then I looked at their financials and I also went, like, what the hell is going on here? And then the more I look into it, I say, they have what's pretty much a monopoly with the U.S. Navy, which is a really good place for a company to be, given our increased spending on the military year after year, and it really does kind of explain how the stock has continued to go up and up and up. So always try to get the full story of a company. Don't just rely on stats. The stats don't tell you good buy or bad buy. Just clicking stats doesn't do it. The stats, all they do is they contribute to a story. You are responsible for coming up with the overall narrative. It is up to you to do the research to find the overall narrative. The statistics merely tell you you should look into this or you should look into that. They're tools that help you come up with the narrative, but at the end of the day, you as the investor need to come up with the narrative rather than simply clicking here and saying it's a buy or a sell based on, a couple of stats. Okay, so next up, I'd just like to talk about low-cost stocks, penny stocks, biotech stocks, and we're just going to get into a couple of the things that you should look for when investing in these stocks. A lot of people like to go for the cheap stocks because, they're cheap, and if you buy a stock at $30 and it goes up to $35, okay, you made some money. But if you buy a stock at 10 cents and it goes up to $35, I'm rich. And everybody likes to get into stocks because they want to get rich. And so I know that people are going to look at the penny stock area. And now, since penny stocks often do not have positive earnings yet, a lot of penny stocks don't even have, proven revenue streams, or their expenses are far greater than their incoming revenue. You can't use the traditional metrics. You can't use return on equity. You can't use price to book or price to sales, because you're not going to get a real number since their revenue is negative. They lose money. Not the revenue is negative. Their net profit is negative since they lose money. So we're just going to look at a different set of characteristics. It doesn't mean that the financials are useless just because it's a penny stock that loses money. So let's just take a look at some of the news for this company called DynaVox Technologies. Now, I'm not saying whether I think the stock is going to go up or down. I'm just going to give an analysis that allows you to make your own independent decision. Again, with a lot of investing, you're not going to know. It's not about knowing exactly what's going to happen, because very often you don't know exactly what's going to happen. It's just about learning what to look for so you can be a more informed investor. So this stock went down. It plunged recently because something that they wanted to get approved wound up not getting approved. They were thinking of approval in December or January, and rather than that, it's funny. They actually got a notice from the FDA, and it's pretty funny because it looks like it reads like an admission that the FDA just didn't do their job. So if we read over here, the CRL seeks information regarding several topics, including clarification regarding specific adverse effects of special interests, AESIs, a numerical imbalance in a small number of cardiac events, blah, 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 blah. In the CRL, the FDA acknowledged that it has not yet completed its review of responses received from DynaVox in early October, including those pertaining to AESIs and the numerical imbalance in cardiac events. So, on November 14th, the FDA sent this company a letter saying, hey, we're going to admit that, yeah, I know you sent us information regarding this, but we didn't fucking read it. Typical government agency, man. This is where your taxes go. Anyway, so let's forget this. Let's just forget it. Let's just try to not think about how frustrating the government bureaucracy is for a second here. And look at this. DynaVox expects a Class 2 designation for a resubmission of the BLA, which would result in a target review period of 6 months. So this is the important thing. This is the metric that I want you to be. This is the information I want you to be looking for. With these companies, it's not always about revenue. It's about whether they can just continue to stay in existence. So now over here, you see it says target review period of 6 months. So my question is, I know the FDA moves slow. Does this company have the finances to stay in business for another 6 to 9 months? And ideally a little bit more than that, but let's just see if they have the finances to stay in business for 6 months. Again, as I said, the problem is not that there's too little information, is that there is too much information, and when you first get into this, you don't know what to look for. So what I want to look for when I read this is, okay, there's a good chance of it getting approved, but 6 months, oh man. So it seems like this is just the FDA buying time because they didn't feel like reading everything that they got. So let's just take a look at the company financials. So when I go to the company financials, I'm going to go to the balance sheet. First we're going to start with income statement and quarterly. I want to see what their expenses are. So I want to see at the very least, can this company stay afloat for the next 6 months? So their total revenue is about anywhere from $160,000 a quarter to $1.2 million a quarter. Their total operating expenses are anywhere from $28 to $35 million. So this company loses anywhere from $27 to $35 million. See? Net income, $27 to $35 million loss per quarter. Now, 6 months is going to be 2 quarters. So a quarter of a year, which is 12 months, is going to be 3 months. So 2 quarters. So if they burn through $35 million a quarter, that means that they would need about $70 million in order to move ahead with everything. So if we go to the balance sheet and we go to the quarterly balance sheet, their total assets are $139 million, but a lot of that is in cash and short-term investments. But they only have $23 million in cash. And do keep in mind that this is probably going to take it's going to take closer to a year to get any of this done. So let's say it takes an entire year. That's about $140 million. Because again, it's not like the FDA moves it. It says 6 months, but there's a lot of red tape afterwards. It's not like the FDA and getting this stuff approved moves at the speed of light. So let's say it takes a year. That's going to be $140 million. This company's total assets before we even get to debt is $139 million. They have $23 million in the bank. The money that this company has in the bank is not even going to last them 1 quarter right now without them selling off a lot of what they have. And yeah, again, the company's total equity is lower than what it's going to cost them to be around for a year. So now, at least we can make an informed decision. Can this company be in business for a year without serious restructuring? No. Can this company be in business for a year without hitting a home run on some other thing they're doing? No. And is this company likely to stay in business for a year without obtaining funding from somewhere else? No. Now, I'm not going to say that the stock is going to tank. I'm not going to say that the company is going to go bankrupt because, again, I don't know what's going to happen. I don't know if maybe some angel from the FDA will go, oh, my bad, bro. We actually read all that stuff. Oh, yeah, they sent that out by mistake. You're approved. You can start selling and making billions. Stop. We don't know what's going to happen. We can only work based off of what's in front of us. And one of the important things when it comes to penny stocks or cheaper stocks and biotech stocks is, because they're not always making a lot of money, is do they have the funds available to stick around until good news comes in the horizon? Because once good news comes, then it's easy to make money. You can make money off of good news. You can't make money off of bad news and mounting debt from your business expenses as a medical research company. So this over here does not, again, it's one of those things where if you want to roll the dice, by all means roll the dice. Just realize that you are rolling dice and that this is more speculating than investing. And as I said, it's okay to gamble. Sometimes a little bit of gambling is just fine. Going to a casino and gambling or rolling dice is just fine, but just realize that what you're doing when you invest in something like this, you're very much so rolling dice, and you may make a lot of money. There's a chance that you get snake eyes and you're good, but there's also a chance that you get fucked and go broke. So what I would do is, if I were going to speculate on something like this, I would make sure that it doesn't take up a large portion of my portfolio. So anytime you decide that you are going to speculate on something, anytime you decide to take a risk, by all means go ahead and take that risk, but keep that risk to 10, 20, 30, 5% of your portfolio. Don't make risky stuff like this 70 to 80% of your portfolio unless you are simply rich and don't care about losing the money. Any money that you put into companies like this, you need to be okay with the fact that every single dollar you put in could be gone. So I would not put more than 5% of my portfolio into something like this because, again, there is a good chance that it would be completely gone. And you can see the company, when the company was doing good, they were up as high as $29, but again, past performance does not dictate future stock price. So I know what people are going to do. They're just going to click on the max of the graph or the 5-year or the 2-year, and they're going to go, wow, this has the potential to go back up to 48. It's a great buy. It's a great buy if you're okay with the risk. And I'm not saying that it's going to go up. I'm not saying it's going to go down. I just want you, my goal is to get you to be able to know what to look for so you can do your own research to find out that investing in something like this is a risk and not a guarantee just because at one point in time it was $30 or $48. I want you to be able to look through the balance sheet, look through the income statement, look through the news, and be able to put them all together in a logical way. Because the news, what the company is actually doing, their income statements, and their balance sheet, it all fits together, and it comes together to a narrative that allows you to decide whether or not this is a risk that you want to take, and that's really that. So when it comes to any of these types of penny stocks, and it goes for almost all of them, if they say, we will know if this is going to be great by the end of the year, and they have enough money to last for 2 weeks, think before you invest. Now, if you're dealing with a company where they're expecting to hear back on something that they're doing in 2 months, and they have enough money in the bank to last them 18 months, then again, it's still a little bit of speculation because you don't know what the news is going to be, but at least they have the money to get themselves there. So I just want to make sure that anytime you invest in a penny stock or anytime you invest in one of these stocks that doesn't make money, that you look at the news, okay, what are they expecting on the horizon? How long is it going to take to receive those results? Does the company have the financing to get them to that result? Because if they don't, that stock will very likely fall off a cliff and you will lose all your money, and that would be very, very sad. So now I'd like to discuss why, for a lot of people, investing in some type of index fund, investing in something that tracks the S&P 500, may actually be better off for them than investing in individual stocks. When you invest in individual stocks, it's not likely that every company you invest in is going to go down or go bankrupt, but it is a possibility. The S&P 500 tracks about 500 different large cap, large companies that there's not a high chance of them going out of business like some small company. And even if one of them goes out of business, it's 1 out of 500. It's not going to hurt the entire fund that much. So when you invest in something like this, it doesn't go up very quickly. You don't have these huge gains. Again, today it went up 0.3%. And tomorrow it may go down 0.3%. But what you can see is that the overall average trend is upwards. And even though you have, this is a graph from 1976 to the present, and even though you have these times around the dot-com bust and also in 2008 when the financial crisis hit where it went down, you can see even from those it did recover. It always recovers. Now, I want to talk about why it is that you are sadly probably always going to be behind the index funds, why you're probably always going to be behind the market as a whole. As I said, the market is not, again, the prices of the stocks, they're not controlled by somebody in the sky who writes on a chalkboard the number, and that's what the price is today. It doesn't work like that. It's supply and demand. If more people want to buy than people that want to sell because there's good news, this price will go up. If more people want to sell than people who want to buy because there's bad news, the stock will go down. And I want you to really think about that for a second. I want you to think about who is going to get news, where it's coming from, and who has a chance of getting the best news first. We get our news from Google, from radio, from television, from news websites, from company press releases. Whereas JP Morgan and Merrill Lynch, these large multi-billion-dollar organizations, they get their news directly as it comes out. They don't have to wait for it to turn into a YouTube video. They don't have to wait for it to make its way to the New York Times. They don't have to wait for it to show up in Google or Yahoo Finance because they are creating the news. They are receiving it in real time. These companies are paying billions upon billions of dollars to have analysts and investigators that work around the clock in buildings in the financial district and all over New York City to do nothing but gather news in the companies they're invested in. So that when there is bad news, they can be the first person to sell that fund out of their index before people like us figure out that that stock is shit and decide we want to sell it. By the time that we figure out that there is bad news about a stock, Merrill Lynch and JP Morgan have most likely already sold it. And by the time we figure out that there's good news about a stock and that we should buy in, JP Morgan and Merrill Lynch and everybody else and all the hedge funds have probably already bought in to that stock and increased its price. So by the time we get good news, by the time we see good news show up on the screen, that's already been factored into the price of the stock because all the hedge funds, all the investment banks that have billion-dollar operations to gather news directly from the source that can afford to do that have already received that news. The market is defined by us, by the people who are in it. And there are a lot of people in this market that have much better outlets or much better news gathering capabilities than we do, so they can get that news first so that they can act on it before it's affected the market. So we're all competing with one another in the stock market. And the best thing to do for the long term for most people, I would say, is to just invest in some type of index fund. So this way you are not, you're not competing with everybody else. Rather, you kind of become the market in a one way or sense. Blackberry, don't dig your claw into my leg. I'm not wearing jeans today. Blackberry. I wish I had a camera so you could see what an asshole my cat is. Anyway, so this is why, unless that you're probably not better off buying individual stocks and picking them yourself unless you have a better way of retrieving news than the investment banks do. And if you do, more power to you. Now you may ask, Lewis, why do you buy individual stocks and do your research and all this, that, and the other if you're competing with everybody else? Well, as I said, to me, This is a little bit of a hobby. It's a way to stay engaged with the world. It's a way for me, when I wanted to invest in rail, or when I want to invest in a coal company or a private prison company or anything else, I have to kind of understand what's going on. So it gives me a motivation to stay up to date with what's going on in the world, and it keeps me engaging my brain, and it keeps me outside of my bubble of, just what I'm experienced with. And I enjoy that to some extent, and it's fun for me. But at the end of the day, if my pure goal were just to, just watch money slowly grow over time without any risk, I would just invest in an index fund or something that tracks the S&P 500, and I would just, check it once a year and call it a day. Lastly, when it comes to things like day trading, meaning you buy and sell stock every single day based on technical indicators, if you're new to this, honestly, even if you're not new to this, I would just suggest that you avoid that practice. That is really a game that you're very likely to lose. You could have probably made the same amount of money, if not more money in the long term, by simply picking good picks and just letting it be. But just try to avoid day trading. Day trading is this, again, this is an opinion matter. I'm not a financial professional, but I would just suggest if you're getting into doing this, avoid day trading. That is a game that you are very, very likely to lose. And even if you win, you will have put in all of this work and all of this time and all of this effort, and you might have made the same, if not more money, if you had simply just chosen good picks and just stepped away from the computer for 6 months and came back and saw that they all went up. So I would suggest avoiding day trading altogether. The last thing I want to do is include a little bit of an opinion piece. I was going to do a video on this, but I figured since I'm doing a video on stocks, I might as well just toss it into this one. We're just going to be looking at an article from the Washington Compost here. Now that you understand how stocks work to some extent, you can, I guess, you can kind of laugh along with me when you check out articles like this where they say, "The plunge. Did Donald Trump tank Boeing stock because he was mad about a news article? Did he tank the stock?" And they call it a plunge, and I just thought that I would just show you this so that we can all get a laugh together. Now, I don't always, again, I've not been nice to Hillary. That doesn't mean I'm a big fan of Trump. He says a lot of silly shit on his Twitter, and I'm not going to say that this is the best way to get everything across. But what kills me is when people we have this whole new thing now about fake news and how everybody, everything that doesn't agree with what the Washington Post and the New York Times says is fake news, and how independent news is fake news, and we have to teach literacy to fake news so that kids will trust what they read in traditional newspapers more than actually thinking for themselves, and it just drives me up a fucking wall. So I just thought that I would go through this. So they said that did he tank the stock, and they called it a plunge. And I mean, you could read these articles for yourself. They're popping up all over the internet. Now, I don't have to like Donald Trump or be a supporter of him to realize that this narrative is bull. And let's just go over this for a second. So we're just going to look up Boeing over here. Yeah. Here we go. New York Stock Exchange, BA. So let's look up this stock, right? So he made his tweet sometime at 8:50, 8:45 in the morning before the market opened. So we were at, take a look at this. Look, we're at 150, 151, 153, 152, 152. It went to 150 after his tweet. Then it's 152. Then and if you look at this graph over one day, you see that. If we look at over 5 days, well, look, it went from 151.20 to 150.52, then back to 151. If we look at this graph over a month, it went up and down, and up and down, and up and down, and up and down, and up. And if you look at it, you actually can't even see what happened today on the graph if you look at it over a month. That's how small it is. So what all of these companies, what all of this mainstream media crap is calling a stock market tank, it literally does not show up on the fucking graph for 1 month. You can't even see it. And if you go over 3 months or 6 months, this is, now that you are a little bit more informed about stock, you can see that this is bullshit. So from September 8th to September 9th, it went from 132 to 128. Here, it went from 150, let's see, we're back at 1 day. So it went from 152 to 150, and it's literally back at 152.24. Not only did Donald Trump not cause the stock to tank, it actually is up 0.05% today from where it was yesterday. And I want you to really be able to analyze the bullshit that you see in the news, not just outside of stocks in general. I really, there was this one teacher that I had in high school, one of the few decent teachers, and he said, even if you don't learn anything in this class or you forget everything after you graduate, I will be happy if you have a healthy skepticism towards what you read in the paper, see on TV, or look at online. I want you to think for yourself. So if you have a healthy skepticism, even if you fail my class in the Regents, which I don't want you to do, I'll be happy. And when I look at this, it's like, okay, so if going from 152 to 150 and back to 152 is a tank, what is this? Like if a 1.2% drop, because that's what that 1.2% is a tank, then what do you call this? The reality is that politics are always going to affect the stock market. People put great weight on the words of what politicians say, and that's always going to have an effect on the market. It does not mean there is a conspiracy. It does not mean that there is this evil plan to get riches. And if we have this idea that politicians cannot speak if what they say may affect the stock market, you will never see a politician speak again, which you never know. It may be a good thing with the way politics is going in this country now, but still, hopefully my point got across there. I just thought that was funny since this is in the news this morning. If you're viewing this video far after the date of December 6th, 2016, just Google Boeing stock tank in December 2016, and you'll probably see the same funny articles that I'm linking to here. Like look what they do with the graph. They highlight it in yellow and they make it look like, oh my God! Because this morning I did this. I read this garbage from the Washington Compost, and I look up Boeing and it's like, okay, I know Boeing's a good company. What happened? This has got to be a great buying opportunity. And I'm looking at it and it's like, okay, so it was 152 yesterday and it's 152 today. Am I being punked? I'm sorry. Am I missing something? Like, where's the tank? Where's my buying opportunity? Oh, there is none. This is just the mainstream media being full of shit. But that's it for today. So hopefully that this video has given you a decent introduction into stocks and stock investing. If you want to learn the technical terms, if you want to learn everything else that I didn't include in this video, if you want other opinions, by all means, there are many, many good books written by people who've run successful hedge funds, successful investment banks, and you can read those and you can listen to them to get a little bit more information. And this is not my field. This is just something I do as a hobby. It's something I do quite successfully as a hobby at this point, but it still is in that hobby realm for me. It's not something that I do professionally. So if you do this professionally, you probably know more than I do. But if you don't do this professionally, I hope that you have become encouraged to look into the world of investing and to start increasing your knowledge base by doing research in all of these new fields and just working your mind and expanding what you know and your understanding of the world. Because for me, that is the most fun part of investing.